In this video, we're going to cover the technicals and the price actions of four companies. The first company is Vinco Ventures, trading under the ticker symbol BBIG. The second company is Rivn, trading under the ticker symbol RIVN. The third company is Sofi Technologies, trading under the ticker symbol SOFI. And the fourth company is Paysafe, trading under the ticker symbol PSFE. We will first go through the recent stock progressions and price actions for each of them, and then provide my personal opinion of what should be done with each and every single one of those stocks. We will begin with Vinco Ventures, trading under the ticker symbol BBIG. During the trading session on Tuesday, the stock price of BBIG first went from an opening of $3.22 to a relative high of $3.55. Before meeting a certain amount of resistance and remained near the $3.50 level. Overall, I believe that the recent price action is showing us that the stock is now having its support between the region of $3.20 and $3.50 and waiting at the moment for more volume to go higher. It's interesting to see that over the course of 1 month, the $3 level has proven to be a floor for the Vinco Ventures stock, which is certainly very encouraging given the double pressure of shorting from the dark pools and the sell-off from the market in general. If we look at the progression of the stock since the beginning of the year, the stock price initially went through a high of $5.20 before retracing back to around $3 and managed to maintain there. If we look at the trend over the past 3 months, the tendency is upward and bullish. Of course, if we use a longer time frame, then it has reached a much higher price levels in the past, and of course the further we go back, the higher it was. And it's quite obvious that the retracement in the late 2021 has discouraged a lot of investors. I believe that the current price point is in a zone that deserves our attention and has enough potentials to be pushed upward in the short term. With that being said, let's move on to the second company, Rivn, trading under the ticker symbol RIVN. During the trading session on Tuesday, the stock initially went down from $66.55 to $64.13, which is the lowest point of the day, before gradually going back to above $65, eventually trying to reach the $66 level. There's a clear sign that the stock is not willing to go below $65, but at the same time may lack the steam to go beyond $66 in the short term, even if it would remain as a possibility as well. I believe that the two key support levels to look for are the $60 level and the $55 level, which have been tested and held against selling pressure so far. When we look at the price action of Rivn ever since it began trading, it's not difficult to determine that there will be a lot of challenges ahead. Rivn may have been one of the largest IPOs of EV startups, but it went public in a period of time when the market mood has moved on from the 2020 era, a bit like the bubble that cannot get blown bigger, but remains big enough to leave some room for speculation, a room that can also disappear as soon as the macroeconomic trends go against it. So for example, for the auto sector, we know that the supply issue will remain there, and will remain there for a prolonged period of time. So this will definitely affect Rivn as well. And the other things may include, for example, the market capital just decided to go to other sectors. So going forward, we have to keep those factors in mind before deciding whether we should go in Rivn or not. The third company is Sofi Technologies, trading under the ticker symbol SOFI. Over the past few days, Sofi has been having quite a bit of optimism that is reflected in the stock price, since Sofi is floored around $12, a level that has been tested twice towards the end of Monday, and finally, the stock has rebounded from there to finally close around $12.60, which is one of the first trading sessions since a long period of time to finish higher than when it began. I think that there will come a time when enough volume would be able to push the stock up to reverse the bearish trend, but that moment will come at some point in the medium term. In the meantime, it's going to be a decent opportunity for us to buy in at a relatively affordable price. When we look at the long-term trend tendencies, SoFi has been very popular, but is now facing the similar issues and challenges as the rest of the industries, since many tech companies have been sold off by the market participants in the past few months, and SoFi is no exception. If we look at the company over the past few months, the overall trend remains bearish, because almost every peak is lower than the previous one. This means that there's still a lot of selling pressure for tech and growth stocks in general, and we gotta keep that in mind going forward. The fourth company we will look at is Paysafe, trading under the ticker symbol PSFE. Over the past few days, the stock of Paysafe mostly fluctuated between $3.55 and $3.85 level. It tested the $3.55 level during the early hours on Monday and then bounced off from there around $3.70. Generally speaking, it seems like the ongoing market dynamics are favoring more sustained recoveries going forward, and that a support line around $3.50 has been reached. Nevertheless, we now have to determine whether the stock will be able to go beyond the $3.80 level, because that seems to be a short-term resistance to watch out for. Looking at the stock performance over a longer period of time, there was a point in time when the stock went through a nosedive in November 2021 before the stock price nearly halved. We predicted at the time that the price is likely going to go down slower or even to find a support after the nosedive. That seems to be the case despite significant selling pressure still present, since the stock seems unable to go beyond the $4.15 level and has tested the $3.15 level 3 times over the recent past. With the technicals covered, here's my opinion about each one of them. My opinion on Venco Ventures is that overall, the tendency should remain bullish, but we have to face the potential reality that there may not be enough steam in the short term to push out the short sellers just yet. On the other hand, I think that if they are capable of maintaining the $3 level, this means that they are able to resist to a lot of selling pressure, which is a good sign for a short squeeze stock. I would suggest to start building a position within Venco Ventures at the current level, while keeping in mind that the price may still sell off by an additional 30% from where it is now. The maximum exposure I would recommend is between 1 to 3%, and to allocate 25 to 40% of this amount right now. My opinion on Rivn is that it deserves to have a place on your portfolio, as it is a company that is mostly owned by institutional investors, and that should change your mentality and expectations when investing in it. I would recommend, though, to keep an eye out for the stock once the price is stabilized around a certain price range, and that would be a moment I would recommend to enter in the stock. If the tendencies maintain themselves over the next few days, or I would say even weeks, I wouldn't be surprised to see that the stock may gain a few dollars in the market and take over from there. Currently, the risk profile of Rivn is higher than most blue chip stocks, so definitely tread the landscape carefully as you deal with it. I would recommend a maximum exposure of 3% of your portfolio and buy in batches of 10 to 20% of the allocation every time you go in. Now, let's move on to SoFi. My opinion on SoFi Technologies is that the stock is certainly showing a lot of potentials and is priced at a relatively affordable price level. The reason I say relatively and not absolutely is because with the valuations at where they are at the moment, with any sort of growth and tech and fintech stocks, they cannot really be justified by any sort of fundamental figures. So, despite the significant selling pressure, I think that there's a high probability that a company may go higher in the near future and even eventually reverse this trend. So, I would recommend to start buying SoFi stock now in small batches, with a maximum exposure of 5% of your portfolio, and to keep buying if the stock goes lower. I would say that each time you buy, use 20 to 30% of the allocation to go in and leave the rest for later. My conclusion on Paysafe is that the company does deserve to remain on our watch list for now, because it's going through a different phase compared to where it was just a few months ago, and there's a decent chance that the price is going to bounce back from there than where it was a couple of months ago. Even if the confirmation signals are mixed at the moment, for those who have diversified portfolio that can carry on a risk like this, they can also choose to buy pay-safe right now to profit from a takeoff in the medium term. The maximum exposure I would recommend is between 1 to 3% of the portfolio. The current price point can be an entry point for a maximum of 30% of the allocation. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks being shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.